You are not even maximizing your wealth potential if you've never done this. It's how you're paid up to 5 ways simultaneously with the most proven asset class anywhere. Hi, I'm Keith Weinhold. This is Get Rich Education. Welcome into part 2 of the 5-part video series on how you're paid up to 5 ways at the same time as a direct real estate investor. This video is called Cash Flow.
Average Joe invested in real estate and became a boss. Ever compared investments and wondered, what makes real estate special? Inflation will be your new best friend and you'll be increasing income while decreasing taxes because debt-free is dumb. Compound interest is lame. The US dollar is fake and real estate is real. Real estate simultaneously pays 5 ways.
This video is about cash flow, and this video series is so important because real estate investors have got to ask themselves the question, why are we doing this? Why are we even doing all this? I've even found that veteran real estate investors don't understand where a lot of the returns come from, and there's got to be a great compelling reason as to why you invest in something where you don't just have the ease of pointing, clicking, buying, and selling like you do with something like stocks. I know of 2 ways to optimize your wealth potential in general. It's owning your own business or directly owning real estate. Owning your own business, that takes a certain skill set of entrepreneurship, and it also takes a lot of activity on your part. Real estate investing is passive. You don't even need to be involved most of the time in order to get the return. So that's why we're talking about this. And we're talking about being a direct real estate investor, not investing in a REIT or a syndication, but actually owning the property yourself. In the last video, which was the first of 5, we talked about the benefit of leveraged depreciation, where you get a 30% total rate of return. Real estate only appreciates historically at about 6% per year, but you achieve the 6% return on both your $20,000 down payment that we're using in this example, and you got that return on the $80,000 borrowed from the bank. Both of those are yours, not the bank's. That's how you got a 30% return. We're going to see what kind of return we come up with here and add that onto the 30%. Let's use this same $100,000 rental single-family home example all through these videos. And by the way, if you're thinking a $100K single-family home, I want to go bigger than that. Well, we're dealing completely with ratios here. So if you envision a $1 million apartment building for yourself, you'll just multiply all these figures by 10. If you envision a larger $10 million apartment building for yourself, you'll just multiply everything by 100. So in this single family home example, we'll say you get $1,000 of monthly rent income minus $900 of monthly property expenses. The difference there leaves you with $100 of monthly positive cash flow. And I'm just being conservative here. Some people, if they bought a property like this, they would want more than $100 cash flow, and you can often get that. If you take that $100 of monthly cash flow and multiply it by 12 months, you come up with $1,200 of annual cash flow. All right, well, to get our ROI here, again, our formula is your gain, $1,200, divided by your skin in the game or your down payment. It was a 20% down payment on this 100K property, as you remember from the first video. Therefore, it's a $20,000 down payment, which is your skin in the game. So $1,200 divided by $20,000 equals a 6% rate of return for you from cash flow. This is also known as the cash-on-cash return. You might see it abbreviated CCR, COC, I've even seen COCR, but it all means the same thing. This is important because this is cash to you monthly. This is the most liquid of the 5 profit centers that you have here. In the last video, you had a nice gain, but that was equity that was relatively illiquid and locked up in the property for a while. And by the way, I am wearing a green shirt in this video to emphasize that green cash flow liquidity component that you get monthly. In the last video, I wore blue because that conveys trust, and you need to have trust in the long-term process of taking on debt and having leverage. And blue and green are also the 2 main Get Rich Education logo colors. Let's look at the anatomy of where this $100 of your monthly positive cash flow came from. We discussed the $1,000 rent income that comes from the tenant, minus $900 of expenses. The first is your $400 mortgage principal and interest expense each month, typically your greatest expense. All of the other expenses are known as operating expenses. An easy way to remember what your operating expenses are with the acronym VIMTUM: vacancy, insurance, maintenance, taxes, utilities, and management. Even when I'm speaking up on the stage, you can see me go through them in this order. I still use VIMTUM to help me remember what each of those common recurring operating expenses are. In this case, and this would be fairly typical for a property, your first one is $80 for vacancy. How did I come up with $80? Well, that's 8% of your $1,000 rent, and generally it could be something like 8% of the time where your unit is either vacant or for some reason the tenant didn't pay. $80 for property insurance, $100 for maintenance and repairs, the first M of the VIMTUM. Then we go on to T is for tax, $120. $20 for utilities. In a single-family rental home, the tenant typically pays all the utilities and even mows the lawn, but maybe you'll have a little utility bill while it's vacant. And then $100 for property management. That's what makes this truly passive. Some investors choose to self-manage, and therefore they wouldn't even have this expense. But to summarize, your cash flow is rent minus mortgage and VIMTUM. So to keep this simple, we do some rounding, some simplification along the way here. Hey, if you're getting some good value from this, go ahead and put a like on the video. That tells YouTube that this is a good video, shares it with other people, and this is a transcendently important series where you, for the first time, are understanding how real estate investors really create wealth. Now, in the last video, I told you that this 6%, even though we got 30% from the last video, this 6% is actually the most important income that you can get. Why is that? Because that helps you control the mortgage. You know, if real estate values fall over time, you're still going to be covered because your rent income exceeds all the expenses. So even if real estate values were temporarily suppressed, as long as your rent income exceeds your monthly expenses, you can cover that mortgage, and you should even have a little something left over because rents are actually quite stable. They're even more stable than housing values are over time. Plus, if housing values fall, you know what typically happens? A lot of people get discouraged from buying and they instead become renters, and this increases rental demand. That's exactly what happened to me in 2008. I've been investing in real estate since 2002, but because I bought for cash flow, even in 2008, I was able to easily hold on to the process and even enjoy greater cash flow because there was greater demand for rent since no one wanted to buy and everyone's got to live somewhere. Cash flow is important because this is passive income. So in good times, what cash flow enables you to do is either reinvest those dollars sooner because you get cash back, or increase your standard of living and just spend so you can actually enjoy your life when you're young enough to enjoy it. And so many people overlook that. This is the importance of cash flow. Now, where does cash flow actually come from? In short, it comes from jobs. So when you buy a property, it's important to select a market that has some economic vibrancy and even a diversification of economic sectors, because that place needs to be rented to a tenant where you have a reasonable expectation that they're probably going to have a job over the long term, and when that tenant leaves, you'd have a reasonable expectation that someone else could come in to that unit and pay the rent. This is often why I favor larger metro areas. If you're in a small metro and you buy a property, everything's doing fine. If there's a zinc mine at the edge of town where half the town's employed and the prices of zinc plummet, well, a lot of people lose their jobs and you would lose your income. So it's important to be in a larger, more diverse market a lot of times. So here we go. You got a 6% return from cash flow. Let's add that to the 30% return that you got from leverage depreciation in the first video. And now between that 30% and this 6%, your cumulative total rate of return is now up to 36%. Yes, a 36% year one return, and this is only video 2 out of 5. We still have 3 out of the 5 videos to go to tally up on top of the 36% here. We're just going to keep piling it on. And how high will it go? And what color shirt am I going to wear to signify each one of these profit centers? That'll be coming up next in video 3 out of 5. You know what? If you miss any of these videos, you're never going to know how it all goes together. So what I learned is what you have to do is not just hit the subscribe button, but you hit subscribe and then that notification bell. That's what notifies you when that next video is there for you. Otherwise, you'll never know that I made it. Coming up, it's the third of 5 ways that you profit in real estate investing simultaneously. I'm Keith Weinhold. Thanks so much for stopping by.